The dreaded 5th of April is just around the corner, and you have that nagging feeling that there's something that you should do about it. But good news, all that you need to think about are 5 different things, which we will run through in this video right now. Quick recap, the 5th of April is the end of the tax year, and although it can be a bit nerve-wracking, it's actually a really good opportunity to organise your finances and making sure that you're making use of all of the allowances that are available to you. Now, tip number 1 is actually going to be to download your latest payslip. What I want you to do is have a really close look at some of the specific fields that are within there, because the beauty of this time of year is you actually have a really good idea as to what your total income or total tax paid might look like for this whole tax year. This is really hard to do in, say, August when you're only 6 months into the year because of things like bonus or if your earnings fluctuate at all. But the beauty now is you only have a month or two left, so you can get a really good sense. And some of the fields that I'd love you to take a close look at are, of course, total earnings to date for the tax year. I'd also love you to look at total income tax paid through the year. And finally, what are your total pension contributions that have been made both by you or your employer for the year to date? You might be thinking, why have I bothered to do that? Well, I'd say there are 2 reasons for this. First of all, it should give you a good sense as to actually how much income tax you are paying, and hopefully that can be a bit of motivation for the new tax year to come to make use of some of the options or opportunities that are available to you to potentially reduce that income tax bill. Second reason I want you to do that is it will really help you with the next 4 tips that I'm going to recommend to ultimately make sure that you're making the best use of your money. Tip number 2, check how much you've paid into ISAs for this tax year. So all you're going to need to look at here are any ISA accounts that you have open. Important to check both cash ISA, lifetime ISA, or stocks and shares ISA, and see how much you have paid into each of those since the 5th of April last year. Now, the important thing to remember here is unused ISA allowance does not carry forward into future years. And so therefore, if you do have some space available that could be filled, then you should. Tip number 3, it's all about pensions. So as I mentioned, hopefully you've seen on your payslip how much you've paid into pensions this tax year. Now it's important that you have a look at comparing that to your annual pension allowance. And so for most people, that's going to be £60,000, or if your earnings are less than that, up to your earnings, or if your earnings are actually over £200,000, there is a chance that your annual contribution allowance could be reduced. But if you find yourself in a position where especially your income is close to some of the edges or thresholds with tax bands, pension contributions can be massively powerful for this. So 2 of the really, really important kind of red flags that I'd be looking at is if your income is getting close to £50,000 or maybe just tripping over £50,000, there is a chance that making additional pension contributions could make sense just to bring your total income down below that level so nothing that you have earned is taxed at 40%. Even more powerful than that is if it looks like your earnings are going to be close to or just over £100,000. Now, many people will be aware of this, but it's worth talking about again, this thing called the 60% tax trap. Ultimately, what it means is for every £2 that you earn over £100,000, you will lose £1 of your personal allowance. Now, your personal allowance is an amount of money, about £15,000, that you're allowed to earn totally tax-free every year. And so, using some quick maths, if we were to earn over, say, £132,000, you effectively have lost all of your personal allowance. And that means for that kind of bracket between 100 and 132, you're taxed at about 60%, which is brutal. Now, the good news is that in the eyes of HMRC and the government, they consider your total income to be earnings minus amounts that you've paid into pension contributions. So thinking about potentially contributing that amount that is over £100,000 into a pension can be hugely tax efficient. Tip number 4, I would recommend having a look at all of your bank accounts and seeing how much interest you have earned on them. And really importantly here, I'd be thinking about ones that are not tax protected. So we can kind of ignore things like cash ISAs or any interest you've received in stocks and shares ISAs here. The reason I'd love you to do this is because interest rates have actually been higher over the last couple of years than they have been in the previous 10 years. And what people are starting to find is that they're getting unexpected tax bills because their total bank interest is higher than what you are allowed to receive free of tax. And for those that are curious, if you are a basic rate taxpayer, you're allowed to earn £1,000 from bank interest totally tax-free. If you're a higher rate taxpayer, it's £500, or if you're an additional rate taxpayer, it's absolutely nothing. And so therefore, it's really important we do have a look at that so that we don't get any surprise bills for this tax year. And this is really linked to tip number 2 around ISA allowance. If you do find yourself in a position where your bank interest is quite high, I mean, hey, great news, it's more money for you. But if you have ISA allowance available, this is a really good sign that you could potentially protect some of that interest from tax by getting it into an ISA or even a pension, depending on what your main financial goals are. And tip number 5 is all about checking the remaining allowances which you are due in the eyes of HMRC. Now, HMRC don't give us much for free in life, and therefore where there are allowances available, ways that we can receive money free of tax, it's really important that we make use of them when they are there. And so the remaining ones that I've not talked about are capital gains allowance. So as of this tax year, you're allowed to receive up to £3,000 totally free of tax from capital gains. So that's a really important one to be thinking about. And some of the typical places that you might be using capital gains allowance in are any unwrapped investments. So investments that are held outside of, say, an ISA or a pension. Typically, you'll be thinking about a general investment account here. Also things like rental properties that aren't your main residence. They will also make use of your capital gains allowance as well. In addition to that, you also have your dividend allowance. Now that's £500 that you can receive totally free of tax every year. Now for most people, this might be coming again from unwrapped investments that you might hold in a general investment account. But also if you're a business owner, of course, you are likely to pay yourself via dividends. So that's another place that you could extract some money from with a really low tax rate. And then finally, one that's often overlooked is of course gifting allowance. We are moving into a world where inheritance tax is going to become more and more popular in terms of the number of people that are paying it. Main reason for that being is that pensions are soon to become a part of our estate. Now, what we can still make use of is your annual gifting allowance. This is how much someone can basically give to someone else, and it is immediately outside of your estate. Now, for the majority of people, that's £3,000 per year. However, in the first year, you can actually use the previous year's allowance if you haven't. So you could get started with a £6,000 gift and then give £3,000 per year beyond that to try and extract money from your estate, especially if inheritance tax is a worry. Now, hopefully that's all made sense. They're just 5 things that I'd recommend people have a look at. If it feels overwhelming, typically that's because tax is something that is really linked to every part of our financial lives. So it can be quite difficult to make decisions in isolation. The key to this is building a financial plan so you can understand how tax relates with earnings, relates with savings, relates with financial goals. You really want to have a clear picture around all of those things tying together. And so if you ever have any questions about that, just let me know.